All right, thanks, Alina. Can you see my
Yes, I see
okay,
your
okay,
screen.
awesome. All right, hi everyone. I definitely know some of you, but not all of you for sure. I am Amber Anderson, and as you know, I manage the Historic Rehabilitation Tax Credit programs for our office. Just to give you a little preview, we are going to talk for about 15 minutes about the two tax credit programs, just kind of basics, what they entail, and then we'll have another 15 or so minutes on the Secretary of the Interior standards for rehabilitation that tax credits tax credit projects follow. And then I also, if we have time at the end, I have a couple of case studies, very brief case studies that we can run through to see kind of some examples of how these programs are utilized. My computer, there we go. Okay. All right, so there are two historic rehabilitation tax credit programs available here in the state of Utah. One is a state tax credit for residential properties, and one is a federal tax credit for income producing properties. And both of these programs provide on their own a tax credit, an income tax credit equivalent to about 20% of a project's cost. An approved project's cost. And the programs provide a credit, not a deduction. So a credit is better because it directly reduces your tax liability, the taxes that you pay, whereas a deduction reduces your taxable income and thereby reduces your taxes owed by a percentage. But this is a credit. Credit is better, or more beneficial for the applicant at least. So the two programs have some differing requirements that we'll look at, but also some overlapping requirements, which are the last two lines here. The first is that a building has to be listed on the National Register of Historic Places, which Corey talked about. It doesn't have to be individually listed necessarily. It can be a contributing property in a listed historic district. And the building does not have to be listed at the beginning of your tax credit project. Legally, it has to be listed within 3 years of you finishing a tax credit project. So it's important to get the process started around the same time and have a good understanding that the building will ultimately be listed on the National Register, but don't panic if you think that you have to go through the full nomination process before you can even get started on your tax credit project, because that's not the case. Just make sure to work with us closely, both myself and Corey. And then the second shared requirement between the two programs is that all of the work being done to the historic property inside, outside, and on the historic site itself has to follow the Secretary of the Interior standards for rehabilitation, or the standards for short. And it's an all or nothing approval. So you can't meet the standards on half the project and then just not claim the other half. The whole project has to holistically be evaluated as meeting the standards, or no credit is issued. So we will get into more depth about what those standards are and kind of how those are applied. But so first of all, what's a credit? I already mentioned that it's better than a deduction. It's a dollar for dollar reduction in your annual tax liability. These credits in particular are what are considered non-refundable, but that doesn't mean you don't get the money via a tax refund. You typically do get it via a tax refund. It only means that you can't claim more in a given year than that year's annual tax liability. So if you have a credit that's larger than that year's tax liability, you can carry it forward for a number of years, and that differs between the state and the federal programs, 5 at the state and essentially 20 at the federal. But so here are some examples of what that looks like at the bottom. So say your annual tax liability for the entire year, not just what you owe at the end, but like what you pay throughout the year, the net amount that you pay through the entire year or finish up at the end of the year. Say that liability is $5,000. If you get a tax credit, if you're awarded a tax credit for $4,000, that year you only have to pay a total of $1,000 in taxes. So it's just a dollar for dollar reduction. And if you have a credit that's larger, so the example on the right is, say again, you have a $5,000 annual tax liability, but you get awarded a $6,000 credit. You're allowed to use that $5,000 in the first year because it's non-refundable, but you can carry it forward to the next year. So you'll have an additional $1,000 available to you the next year. And this can get kind of tricky. So if you're really not sure how this applies to your certain situation, I'm not a tax professional, so you definitely want to talk to your tax advisor or a CPA, someone at the tax commission who can provide you with legal advice. And so back to on the first slide, I mentioned that the tax credit programs provide a credit equivalent to about 20% of your approved project's cost. And that's because the credit is applicable to most expenses. On the left-hand column, you see here, qualified expenses are, walls, floors, roofs, fixing your windows, updating your HVAC, but also soft costs like engineering fees, architect fees, permit fees, things like that. But there are a few things that you can't claim the credit on, like the purchase price of the building. You can't get tax credits for just buying a historic building. You can't get credits on building an addition, but the addition still has to meet the standards. And then there are a few other things that kind of differ between the state and the federal, but another big one that is shared is that site work and landscaping costs are not eligible in order to have the credit claimed on them. But again, we still need to review them to make sure they meet the preservation standards. So looking more closely at the state tax credit program, as I mentioned, it's for residential buildings. This program is a little bit easier, well, a lot easier to access because you only have to be spending $10,000, which anyone with a historic building knows is pretty easy to do. That's maybe not even a new roof. I saw a new roof recently that was like 30,000. So anyways, you have up to 3 years in order to spend that 10,000 if you just have small projects, not something major. And currently there is no limit to the number of consecutive projects that you can have. So if you meet your $10,000 threshold in the first year and you want to close out your application and open one the next year, you can do that. If it takes you 2 years and you want to close it and open another one and then have a 2-year project after that, or a 3-year project after that, you can continually do that as time goes on. And so after the project is complete, you do have to maintain compliance with those standards, those preservation requirements for 3 years after the project is complete. After the 3 years, you're free to do whatever you want. There are no liens or covenants or deeds or easement kind of things attached to your property. It is during the project, and then for 3 years after, you have to follow the standards. And then I mentioned that the carry forward amount, if you have a tax credit that's larger than your annual liability, at the state level, you can carry it forward for an additional 5 years after the first year that you claim it. In the federal program, it's for income producing buildings. So that can be residential rental, that can be commercial, that can be office, it can be anything that has an income producing use. And I didn't mention before, but in the situation where you have a residential rental, there is sometimes the ability to qualify for both state and federal tax credits. So historic apartment buildings, for instance, can sometimes qualify for up to 40% in tax credits returned to them if they follow these requirements and go through the application process. The federal program is more complicated in a lot of ways. And one of those ways is that you don't just have a base spending requirement. It's not like the state program where you just have to be spending at least X amount. The amount that you have to be spending is based on your specific building's adjusted basis. And I have a slide for that on the next, the next slide is explaining that. But essentially, the federal program is for substantial rehabilitations. It's not meant for smaller, just like fixing your roof, getting some new HVAC. It's for larger projects typically. So that amount is usually much larger than the $10,000 requirement. And so the timelines are a little bit different with federal projects as well. A standard project has to be done in about 2 years, but most of the time you can request a phased project and have a 5-year window in order to meet that adjusted basis requirement and qualify for the tax credit program. And then I didn't mention this on the state credit slide, but there technically is no retained ownership requirement for the state credit. It will be really difficult to make sure that work on the building continue to follow the standards without maintaining ownership. But technically there is no requirement at the state level. For the federal level, there is a requirement. However, you have to continue to follow the standards for 5 years instead of 3. So 5 years, and you also have to maintain ownership of the property for 5 years. So if you don't do one or both of those things, you have to pay the credit back. And then the federal non-refundable carry forward situation is a little bit trickier. You used to be able to carry the credit forward for an additional 20 years, and technically you still can, but you're required to carry it forward essentially for 4 years. You have to spread it out over a minimum of 5 if you're going to claim the federal credit. That was a change that happened with the tax reform, which isn't really new anymore. I guess that was in 2017, so maybe I should edit that. But and so back to the spending requirement for the federal program, it's based on the building's adjusted basis, and this this is the complicated calculation. It's very different for every building, but most often, at least 50% of the time, we see buildings, the recent purchases. So the calculation is simplified. It's at the bottom. It's just purchase price of the property minus the value of the land when you purchase it. That's the adjusted basis for a recent purchase. So as you can probably imagine, that's usually a pretty large amount. If you have like right now, if you were to buy a single family house for, I don't know, 500,000, say the land was 200,000, you'd still have to be spending 300,000 in order to qualify for this program. So it's usually a large sum of money that has to be being spent. Here's kind of a review. I won't read through all of these, of the differences between the state and the federal programs, the different cost requirements and different timeline requirements. One of the biggest ones, and the one that I haven't mentioned yet, is the very bottom. The state program, our office has the final say over, whereas the federal tax credit program, the National Park Service actually has the final say. So I and our office essentially work as a liaison between the tax credit applicant and the National Park Service. I help them understand if they're eligible, I understand if their work plan is going to be approvable, help them through the application process. And then I'm also the eyes and the ears on the ground for the National Park Service. So they rely on me to tell it to them straight about what's actually happening on site, because it's not always possible to tell that from photographs and other documentation. So how do you get started? Honestly, the first thing I would recommend before doing anything else, before trying to apply, before touching the building, if possible, is to just contact us. We can help make sure the building is either listed on the National Register or is eligible to be listed on the National Register. We can help make sure you understand whether or not you're eligible for state and or federal. And we can also make sure you get started on the correct application process. And I have screenshots of the two different applications on the next couple of slides, but it is different between state and federal, the process that you follow. So it's really just important to talk to us early and often. If for some reason you choose not to talk to us before starting, honestly, one of the most important things you can do before touching anything on the building is to thoroughly document it with photographs, and usually drawings are helpful, basic floor plans, because the only way that we can evaluate whether or not the work that you are doing is going to meet the standards for preservation is to know what you started with. So if you come in with a project that's half done, we have no way of knowing if you got rid of a bunch of character defining features and drastically changed the floor plan, if that was not documented in a way that is readable and understandable beforehand. And then I kind of already have a lot hinted at this, but the safest thing to do with the tax credit project is to reach out and start the application process before starting any physical work on the building. Legally, you can apply after you've started work, not after you finish work, but after you started work. But it's really risky. So if you've done work that doesn't meet the standards, either you're going to end up just completely disqualified, or you're going to have to spend more money to fix it. So it's really not safe to start on tax credit project before you have started the process with us. So just kind of a quick look at the state application. This is what it currently looks like. As you heard from Corey, we have undergone we're in a different department. So we're not in the Division of State History anymore. We're getting a new website. So this application will change in the near future, but this is what it currently looks like if you go to our website and try to open it up. The state application is essentially just a before and an after. This is a screenshot of the before. It's kind of a condensed version of how the federal program works. But the before application is where you document and show what you started with and describe your proposed work plan. And then the after application is just after photographs. And then this is what the federal application looks like. This is an older version, but it looks about the same. An actual part 1 cover sheet with some redacted information on it. So the federal process has either a 2 or 3 step process. If the building is already individually listed on the National Register of Historic Places, then a part 1 is not required. But if it is not individually listed already, you have to do a part 1, either arguing that the building should be contributing to the district that it's in, or starting the process for getting it individually listed. And then again, the part 2 is essentially the same as for the state. It's where you document thoroughly what you started with, lots of photographs, ideally some drawings, and then describe in detail what your work plan is so that we can evaluate whether or not that meets the preservation standards. And then again, part 3 is just the after photographs demonstrating that you did what you said you were going to do, hopefully. Not always the case, unfortunately. Okay, so before we move on to the standards and some case studies, do we have any questions?